Do you wish to achieve financial success? It's a goal that many of us share, but not everyone knows the path to get there. Welcome to a journey that may well change your relationship with money forever. In this video, we'll be mapping out 10 essential money rules that can guide you to financial success. These aren't complicated investment strategies or economic theories, but simple, time-tested principles that anyone can adopt. We'll be exploring the importance of spending less than you earn, the magic of starting to save early, the wisdom of diversifying investments, and the safety net provided by an emergency fund. We'll discuss why it's crucial to avoid bad debt, how money can work for you, and the power of small amounts. We'll also delve into the importance of continuous learning about money, prioritizing retirement savings, and protecting your wealth. So, are you ready to transform your financial future? Let's dive into these rules and see how they can change your financial future. Our first rule is simple yet powerful: spend less than you earn. This principle, though it seems straightforward, is the keystone of financial stability. It's the difference between living paycheck to paycheck and building a solid financial foundation. When you spend less than you earn, you create a surplus. This surplus can be channeled into savings or investments, which can grow over time, leading to financial prosperity. On the other hand, if you consistently spend more than you earn, you're likely to fall into debt. And debt, if not managed carefully, becomes a heavy burden that can lead to financial instability. Think of it this way. Imagine you're a ship. Living within your means is like sailing in calm waters. Sure, there might be some minor waves here and there, but your ship can handle it. However, overspending is like sailing into a storm. The waves get bigger, the winds get stronger, and if you're not careful, your ship might capsize. Now, this doesn't mean you should deprive yourself of all the things you enjoy. It's about balance. It's about distinguishing between needs and wants, and making smart decisions today that will positively impact your tomorrow. It's about understanding that every dollar saved is a dollar earned. So, as you navigate the seas of your personal finances, remember this first rule. It's your compass, guiding you to financial success. Remember, wealth isn't about how much you earn, it's about how much you keep. Rule number 2, start saving early. Let's delve into the magic of compound interest. Imagine a snowflake falling on top of a mountain. As it rolls down, it gathers more snow, becoming a snowball, then a boulder, and finally an avalanche. That's the power of compound interest in a nutshell. When you start saving early, your money has more time to roll down that mountain, gathering interest upon interest, growing exponentially. The beauty of compound interest is that it works even when you're sleeping, eating, or binge-watching your favorite show. It's your money working for you, 24/7. Let's illustrate this with an example. Say you start saving $100 a month at age 25, with an average annual interest rate of 5%. By the time you hit 65, you would have saved $48,000. But thanks to the magic of compound interest, your savings would have grown to more than $200,000. Now, imagine if you waited until you were 45 to start saving the same amount. By age 65, you would have saved only $24,000, and your savings would have grown to just over $50,000. That's a massive difference. So the lesson here is simple. The earlier you start saving, the more your money can grow. And remember, it's never too late to start. Every dollar saved is a step towards financial success. Time is money's best friend. The earlier you start saving, the more money you'll accumulate. Rule 3. Diversify your investments. Now you might be wondering, why should I spread my investments? Well, here's why. Imagine you have a basket of eggs. If you trip and fall, all your eggs could break. But if you spread those eggs across multiple baskets, even if you drop one, you still have others intact. This is the principle behind investment diversification. It's a form of risk management strategy that mixes a wide variety of investments within a portfolio. It aims to smooth out unsystematic risk events in a portfolio, so the positive performance of some investments neutralizes the negative performance of others. Think of it this way. When you diversify, you're not putting all your bets on one horse in the race. Instead, you're betting on several horses, increasing your chances of winning. However, it's important to understand that diversification doesn't guarantee profits or protect against loss in declining markets. It's about creating a balance. You want to have enough variety to shield against risk, but not so much that it dilutes your potential returns. Investing should never be a game of roulette. It's about making intelligent decisions based on research, understanding, and calculated risk. So, whether you're investing in stocks, bonds, real estate, or other assets, remember to diversify. Diversification is not about making quick gains, It's about securing your portfolio. Rule 4, keep an emergency fund. One of the most vital rules in financial management is maintaining a stash of cash for those unexpected moments life throws at you. Think of it as a financial safety net, a cushion, if you will. This could be for a sudden job loss, a hefty medical bill, or a major home repair that can't be put off. It's these unexpected expenses that can derail your financial stability if you're not prepared. An emergency fund provides you with the peace of mind knowing that you have a financial buffer. It's a shield against debt, a tool to avoid dipping into your hard-earned savings or investments. How much should you set aside? Financial experts commonly suggest 3 to 6 months worth of living expenses, but it's always a good idea to tailor it to your personal situation. Remember, the unexpected doesn't have to lead to financial disaster. An emergency fund is the best defense against financial disaster. Rule 5, avoid bad debt. It's crucial to understand that not all debts are created equal. There's good debt and there's bad debt. Good debt is an investment that will grow in value or generate long-term income. Think of a mortgage for a home, student loans for education, or a loan for a business venture. These are things that, in the long run, can increase your net worth. On the other hand, bad debt is something that quickly loses value or does not generate income. Credit card debt is a prime example. It's often used for things we want but don't necessarily need, like that latest smartphone or designer shoes. Its high interest rates and the speed at which it can accumulate make it a dangerous pitfall. The key here is to think before you borrow. Consider the long-term implications of your debt. Remember, if you can't afford it, then you don't need it. Scene script. Rule 6, make money work for you. Now, the idea of making money work for you sounds like a dream, doesn't it? But it's not as far-fetched as it might seem. This is where the concept of passive income comes into play. Passive income is money you earn without actively working for it. Think of it as having a small army of dollar bills marching out each day to bring back more dollars. It's the income generated from rental property, dividends from investments, royalties from books, or even revenue from a blog or YouTube channel. The beauty of passive income is that it can provide income 24/7, 365 days a year, whether you're working, sleeping, or sipping margaritas on a beach. It's like having a money machine that's always on, churning out cash. Now, why is passive income important for financial independence? Because it breaks the link between your time and your money. With passive income, you're not trading hours for dollars. This means you can earn money while focusing on other things that matter to you. Perhaps writing that novel you've always dreamed of, or spending quality time with family. But remember, building a passive income stream usually requires a significant upfront investment of time, money, or both. But once it's set up, it can provide a steady stream of income with little ongoing effort. Passive income is the key to financial freedom. Scene script. Rule 7. Understand the power of small amounts. Picture an acorn. Alone, it's not much. But given time, that tiny seed can grow into a towering oak tree. The same principle applies to your finances. Here's the thing about money. It's not always about the big bucks. Small amounts, when consistently saved or invested, can accumulate into significant wealth over time. It's the magic of compound interest at work. Think about it like this. If you save just $5 a day, that's $150 a month. Over a year, you've got $1,800. Over 10 years, that's $18,000. And that's not even taking into account any interest you might earn if you invested that money. So don't disregard the pennies and the dimes. They may seem insignificant now, but given time, they can grow into something much more substantial. Just remember, little drops of water make a mighty ocean. Scene script. Rule 8. Keep learning about money. In the ever-evolving world of finance, staying informed is not just an option, it's a necessity. The landscape of personal finance is constantly shifting, with new investment opportunities, financial tools, and economic changes surfacing every day. To navigate this complex terrain, we must arm ourselves with knowledge and continually expand our financial literacy. Think of it as embarking on a journey. You wouldn't set out on an unfamiliar path without a map, would you? Likewise, understanding money and how it works is the roadmap to financial success. It helps you make informed decisions, avoid costly mistakes, and ultimately steer your wealth in the right direction. Learning about money is not a one-time event, but a lifelong process. It involves keeping up with current financial news, understanding market trends, and even brushing up on economic history. It means exploring different investment avenues, understanding the risks involved, and learning how to balance your portfolio. It requires you to grasp the concepts of interest rates, inflation, and taxes, and how they can impact your wealth. And remember, Learning doesn't have to be intimidating. It can start with reading a financial blog, attending a seminar, or even listening to a podcast. The goal is to make learning about money a habit, an integral part of your financial journey. Knowledge is power, especially when it comes to money. Rule 9. Prioritize retirement savings. It's a phrase that might seem a bit overwhelming, especially if retirement feels like a distant reality. But here's the thing, the sooner you start, the better. Why? Because of the magic of compound interest. Imagine you're planting a tree. The sooner you plant that seed and start nurturing it, the more time it has to grow. Your retirement savings work in a similar way. The earlier you start, the more time your investment has to grow. With each year that passes, your savings don't just increase, they multiply. This is the power of compound interest. Yet why should retirement savings be a priority? Well, consider this. The future is unpredictable. While we all hope for a financially secure and comfortable retirement, there are no guarantees. That's why it's crucial to start building a nest egg now. It's about creating a safety net, ensuring you can maintain your lifestyle and take care of any unexpected expenses in your golden years. Remember, retirement savings isn't about setting aside huge amounts. It's about consistency, about making regular contributions no matter how small. And the best part? Many retirement savings plans come with tax benefits, which means you're not just saving for the future, you're also reducing your present tax liability. So, start today. Open a retirement savings account if you haven't already. Make a plan and stick to it, because in the end, you're never too young to start saving for retirement. And finally, Rule 10, protect your wealth. This rule is the shield that safeguards those hard-earned dollars, the fortress that stands between your wealth and the uncertainties of life. One way to do this is through insurance. Health, life, property, even income insurance. They all serve as buffers against financial mishaps that could drain your resources. They may seem like unnecessary expenses, but in the face of adversity, they can be the difference between a financial setback and financial ruin. Another crucial aspect of wealth protection is estate planning. This isn't just for the ultra-rich, it's about ensuring that your wealth is distributed according to your wishes after you're gone. It involves creating wills, setting up trusts, and assigning power of attorney. It's about leaving a legacy, not a burden. Remember, it's not just about accumulating wealth, it's about preserving it too. And there you have it, the 10 money rules for financial success. We've traveled a journey from understanding the importance of spending less than what you earn, to the power of starting to save early. We've explored the necessity of diversifying investments and keeping an emergency fund at hand. The significance of avoiding bad debt and making money work for you has been underscored. We've delved into the power of small amounts and the value of continuous learning about money. Prioritizing retirement savings and protecting your wealth have also taken their rightful places in our discussion. These rules are not just tips. They are foundational stones for building a solid financial future. They are designed to provide you with the tools you need to make informed decisions and to cultivate a mindset that appreciates the value of money. Follow these rules, and you'll be well on your way to financial success. Thank you for watching. And remember, the key to wealth is in your hands.